Good evening to you in business news at this hour. Economists are split on the Reserve Bank's next monetary policy move. Analysts say there's a case for an interest rate cut when the central bank announces the outcomes of its monetary policy committee meeting tomorrow. Others are expecting the SARB to again leave the repo rate unchanged at 7.5%, where it has been steady since January. While inflation edged higher to 2.8% in April, it remains within the SARB's 3 to 6% target range. Citadel chief economist Maarten Ackerman speaks to us about all these dynamics. Thank you so much for your time, Maarten. What is the general market expectation on the repo rate decision?
Yeah, I think at the moment it is probably for a hold. But I think most people in the market would like to see a cut. You know, if we just look at the weakness in the economy, we look at where inflation is at the moment, you know, really at the lower end of that target, consumers being under pressure. And the fact that, you know, you can probably argue slightly behind the curve compared to the US Federal Reserve. When they started cutting in this period, you know, they've cut 0.5%, and we only did 25 basis points. So since then, we haven't actually catch up in terms of those cuts. So there's definitely room for a cut, but I think given the outlook that the Reserve Bank normally tables for potential inflation going forward, we think that the governor is probably going, or the Reserve Bank is probably going to stay on hold for this meeting as well.
Let's go further into the scenarios that you've painted there, especially the global picture in terms of what then is South Africa meant to be looking to, or rather not, especially as the global landscape is quite uncertain. But some analysts have warned that South Africa should not be pitting itself against the likes of the US in the status of their economy.
Yeah, so, you know, if you look at what's happening elsewhere in the world, you know, we're seeing cuts from banks like the Bank of England, the ECB, European Central Bank, they're cutting. The US is basically on hold at this point in time because they are concerned about inflation pressures in that economy. Obviously, with all the tariffs, inflation is potentially a problem in the US more so than any other country because they are paying for those tariffs, and that will filter through to the prices that consumers are paying. So that's why the US is in, call it, a wait-and-see mode. And our central bank, you know, not that we try and manage the currency, but we are very sensitive towards what the US is doing and then what we are doing. So if we cut too quickly, we remove some of the spread or the yield enhancer, if you like, which then implies that the rand can actually get weaker, and that is inflationary down the line. So I think the governor and the Reserve Bank is taking that into account, and that's probably why, like I've said, you know, we've seen a hold kind of status at this point in time, given that that's in line with what's happening in the US. Then the other thing that we need to keep in mind is that there's a lot of talk about changing our target, changing our range. So I think, you know, part of the policy that we're seeing at the moment is almost like proactively getting us to where they want us to be from an inflation point of view before they actually make those changes.
Interesting that you raise that inflation targeting matrix. Of course, discussions around that intensifying that there would possibly be an alteration there. What would the value of lowering that range from the current 3 to 6% be for an ordinary South African?
Yeah, I think it's very important. So, you know, if we have a range of 3 to 6%, then typically you have higher inflation expectations. So if you think about anybody adjusting their, let's say, the rental agreements, you know, they typically start with 6% or higher. If you think about the trade unions, when they start negotiating around salary and wage increases, they also will start with 6% plus. So if we can get inflation to be consistently lower, and therefore on the lower end of whatever target they might decide on, but let's say they decide on a single 3% target, and the Reserve Bank can show that inflation can stay around that 3%, you've basically lower inflation expectations in the economy. So then it's very unlikely that people will start adjusting rental contracts or wage negotiations at 6%. You know, they will start to peg it at 3%. So if they can achieve in doing that, then longer term, you are actually in a position where we can have structurally lower interest rates, which is a good thing for the economy. And that's probably why at this point in time, the Reserve Bank is driving it a little bit longer and harder. So, it is painful. We're taking the medicine now, but inflation has been behaving very, very well over the last couple of months, and is at that lower end of the target. So we're very close to the point where they can change the target, move it lower, and then, they can start longer term to reduce our structural interest rates as well.
Thank you for your contribution. Maarten Ackerman is a chief economist at Citadel, talking us through expectations on the eve of the outcomes of the Monetary Policy Committee to be announced tomorrow. That's where we leave it.